Today, I want to talk about one of my favorite words, which is awareness. Having awareness on a particular whole life insurance product in this particular video is what we will be discussing, and having awareness is key. Having awareness of the different options that are available up front really prevents someone from having buyer's remorse. Meaning, I take out a whole life insurance policy thinking that it's the best option that accommodates what I want to do with my policy, only to find out after I've started the policy that a better option existed. So we're going to talk about one whole life insurance product today. It's Guardian's L95 policy. We're going to look at a specific case study. We've got a 55-year-old individual funding a policy with a total of $500,000. We're going to go through the product, really demonstrate the flexibility, but then we're going to look at the PUA rider that is available, and you'll see exactly how this PUA rider works and really what's important to be aware of when selecting the appropriate PUA rider for yourself if your goal is to maximize the cash value. So let's get on into it and have some fun. What we've got to kick things off, we've got an age 55 male, preferred health rating, which is the second best health class. We do not have him at the top health rating, just regular preferred. The funding we're looking at is $100K per year for 5 years, which is a total of $500,000. Now, with that said, this is very important, which is a big reason why we're considering Guardian in this particular case. Guardian is phenomenal, one being one of the 4 major mutual companies. We've seen them deliver strong cash values to policyholders, but they are also extremely flexible when it comes to their PUA rider. So in his particular case, he wants to be able to fund $100K per year, but he does not want to be billed for $100,000 every year. In fact, he wants to be billed for the minimum, which you will see is approximately $10,000 per year. We're going to go through the exact illustration so you can see the true minimum commitment, meaning the minimum premium he will be billed for each year. So we want to be billed for $10K, or as low as that premium can be, and then have the option to add another $90,000 per year to his PUA rider. And I said option here. So one thing that is beneficial to be aware of is if you go with a policy like this, where you're taking the policy out and your plan is to get a total of $500,000 into the product over the first 5 years, but then you don't do it, will you be penalized? No, not at all. You've got the option to add a total of $100K per year, but you may end up funding it completely different. Maybe you get $100K into the policy years 1 and 2, then year 3 is just $50,000, then $10,000 in year 4, then you make a huge catch-up payment in year 5, and you're up to a total of $500K. Or perhaps it's just $50K per year for 10 years. My point is you can adjust as time passes. But to get back on track here, the L95 product is what we're looking at, and the L95 product, specific to Guardian, has 2 different PUA riders available. You've got one PUA rider with a 5% PUA fee, and then one with a 10% PUA fee. This is the important item to be aware of. Before we hit on that though, I want to talk about this a little bit more because this piece is so beneficial to be aware of, and you're going to see that the product is designed in an identical manner when we look at both the 5% and 10% PUA fee. It's the exact same policy. So pretend this is you. You want to be able to fund $100,000 per year. So the total funding is $100K per year. So where is the money going? That's the big question. Well, we already mentioned that. Over here, $100K per year, he wants to be billed for $10,000 per year and then have the option or flexibility to add another $90K per year. So here in red, we've got our base premium and also our term insurance rider. The approximate amounts of both are $9,000 and then $1,000. So those 2 figures combined give you what? $10,000 per year. That is the minimum commitment, meaning the amount he will be billed for each year on his policy anniversary date. The policy anniversary date is a fancy word for your premium due date. So here's the minimum commitment and how these dollars work. So term rider premiums, those do not build any cash value. The purpose of a term insurance rider is to add more life insurance to the policy at a very low cost, which raises your MEC limit. So you'll see when we look at this policy, we've got the base premium plus the term rider. With respect to the first year cash value, just about zero. You've got a couple bucks in here, a few $100, because the base premium does give you something, but in the first year, it's very close to zero. The second year, that base premium does begin to come back to cash value. But what happens here is when we look at both the whole life policy, meaning what the base premium purchases us, and also the term insurance rider, the death benefit this individual is going to have will be kind of an oddball number, $1.38 million. And where we came up with that number, because we could have just rounded up to $1.4 million, we solved for the minimum death benefit possible to give him, guess what? A $100,000 MEC limit, because we want to prevent a MEC or a taxable event from occurring with his life insurance policy. What are the core benefits to the cash value? Why are people often interested in the cash value? Those three core benefits: safe, liquid, and tax-free. Tax-free if we prevent a MEC from occurring. There are other taxable events that can occur as well, which I would check out any of our whole life taxes videos for more information on that. But point here is we've got the policy designed with minimum expenses, a minimum commitment, about $10K per year. And then he has the ability or flexibility, flexibility, you can use either word, to throw in up to another $90K per year. So very flexible there. And there's the total funding of $100K per year. And that's what we're going to look at. But we're going to look at these two guys right here, the 5% PUA fee and the 10% PUA fee. Now, before we look at the illustrations, which one sounds better? The lower fee, the 5% PUA fee. Obviously, if I have lower fees, that should result in what for me as a consumer? More cash value. The lower the fees, the better with just about everything. Here's what you'll find with a life insurance policy. When we look at the non-guaranteed values, let's call that the dividend values based on the insurance company's present dividend interest rate. What you'll see with a lower PUA fee, the 5% PUA fee, for example, you'll see stronger cash values up front, but long term, you'll see weaker cash values. Meaning the 10% PUA fee, long term, will have more value. So when we look at that on paper, the 5% and 10% PUA fee, that the 10% PUA fee has more long-term, you'll see it really start to become noticeable after about 10 years. Sometimes it's a little bit more, but I've got more money long-term. All right, sounds good if I like the long-term option. Purpose of this video is what? Awareness. What is often displayed in the life insurance industry or shown to consumers is typically the non-guaranteed values. What is not always shown are the guaranteed values. In this case, in all cases, it's beneficial to see the guaranteed values. In this case, it's even more beneficial, or it's great to be aware of what those guaranteed values show. And the reason why is because when I look at a lower PUA fee on the non-guarantees, it won't look as strong long-term. However, on the guarantees, it'll look stronger up front, but it will also look stronger long-term. Now, that's something that's very beneficial to be aware of as a consumer before starting a policy. And both are good options. We've got a quality company that we've seen always deliver, one of the 4 major mutuals. I like them a lot because of their PUA flexibility and such. However, if someone's only shown one option, or they're shown both, but just based on the non-guarantees, and then they see this after the fact and they say, you know, I really like the guarantees with a whole life insurance product. I would have picked the option with the stronger guarantees, but it was never shown to me. That's where you get that sick feeling in your stomach or in your chest. You're like, no, we don't want to do that. We want to make sure that the options, the important options, were shown up front. So let's take a look. We'll demonstrate this a little bit. If we take a look at this guy, what we've got is the 5% PUA fee. Now we've got 3 columns. Look at the center. Non-guaranteed current. This is based on the company's current dividend interest rate. First year cash value, $88,000 and change. He paid in $100K. The policy design, remember what we explained? What was the base premium and term rider? Just about $1,000. So we used round numbers. Here's the exact base premium with this particular design. And then here's the first year term rider cost. And then everything else is going into PUAs. So, paid up additions rider, STP, that represents short-term performance, which is the 5% PUA fee. You'll see this in the full illustration as well. We've got some videos that discuss a full illustration and highlight exactly where you can find that. But first year, $88,000 and change. That's the only thing I want to look at first, in addition to this. And this. So why I'm looking at this, because this is a whole life 95 product. Here's the whole life death benefit. Here's the term rider. Net death benefit is $1.38 million. Take a mental snapshot of the values you see here up top. Whole life death benefit, base premium breakdown, PUA rider breakdown. Tell me if those change at all when we look at the next illustration. Not at all. You've got the exact same figures here, same whole life death benefit, same term rider, same base premium. That term rider cost a little bit different? It's a little bit different, even though the amount's not different. What else is different? Do you remember what that was in the last illustration? $88,000 and change. Now it's $83,000 and change. What's the difference? Paid up additions rider. We don't see STP. This is the standard 10% PUA fee. So what's happening here, more of that PUA payment is satisfying an initial fee, which is going to the insurance company. As a result of that, a little bit less of this purchases me more whole life insurance death benefit, and the term rider is bought down a little bit less. So here with the higher PUA fee, the term cost is actually a little bit higher. You'll notice with a lower PUA fee, because more of your money is deposited into your policy, shows up in cash value, buys you more whole life death benefit, that will reduce the term rider cost faster. Here, not quite as much. It's not a big difference, but that is the one difference you'll notice up top. Aside from that, everything's identical because it's the exact same policy. But then as we look at the cash value over time, here you'll notice the break-even point is just about year 5. You've paid in $500,000, you've got $499. Going back to the last illustration, what do you notice? Well, by year 5, you've paid in $100K, you've got $515 and change. You actually break even in year 4. Now we can scroll down and then take our mental snapshots, looking at everything side by side. So 5% PUA fee, break even year 4. By year 10, you're at $623. What are you at on the 10% PUA fee? $622, just about the same. Looking at it long term is the difference. So we can keep going back and forth, but let's simplify this a bit. So here we go. We've got everything side by side, 5% PUA fee. This is the illustration we just looked at. What's highlighted in year 4 represents your break-even point, meaning you've paid in a total of $400,000 and you have $400,000. Got the different columns here. Annual cash value growth. This represents the net growth on your life insurance policy. Example, year 1, you pay in $100K, $88,000 in cash value, which is just about a $12,000 hit there. Total gain on cash value is going to take into account all years. So if I look at it in the first year, it's the same. Just about a $12,000 hit. Year 2, however, if I look at the annual cash value growth, I paid in $100,000. It was $88,000. Now it's $189 and change, meaning I got my $100,000 back. plus another $1,663 on top of it. Total gain, however, came down a little bit. I'm at about a $10,000 loss. The reason why is because I've made total payments of $200,000, but my total cash value is almost $190,000. A quick side note, a lot of people who are interested in the borrowing feature are very interested in this because they want to make sure, or they want to know, what is the policy growing by? Because when I start to take out loans and I've got a cost to borrow, I can see exactly what that cost is and compare it to my total growth, whether I'm looking at the total gain or just the yearly gain. So what you'll notice here, when we are in the yellow, is when we're no longer in the red on the total gain column. Now we've got a positive cash value, which is fantastic. So he's paid in $500,000 total. There's the long-term value. Let's compare that with this guy. And up top, non-guaranteed. So these are based on those current value sections on the illustrations we just looked at. What do you notice? Well, the big noticeable difference is in the first year. Like, where do people feel it the most with a whole life insurance policy? First year. That's where it's going to hurt the most. The premium is going to take the biggest bite out of the cash value. If we have a higher PUA fee, that's going to enhance that bite. So they're going to take a bigger chunk out of our policy. But the argument behind a higher PUA fee is that the insurance company is going to take more money up front, but then in turn, they should be able to give you more money long-term based on what they can do with that money. The thing to be aware of is that it is non-guaranteed, which is why they provide options so you can select the option you're most comfortable with. And a quick side note here, if unsure, but you really like the flexibility here, you could just split it. There go 50% with one, 50% the other, or 30-70, however I want to do it. In any event, looking at this, what do you notice? Break even is just about year 5. Year 6, I'm positive. Year 10, I'm all but even when I look at them. Lower PUA fee is slightly higher. If we go down to the bottom here, we can create a cash value difference column. Well, let's just scroll down a little bit. And let's look at age 80. What's the difference in value? On the left, you've got your 5% PUA fee. On the right, your 10% PUA fee. Just about a $100,000 difference. So which one would you pick there? I'd say most would likely pick the 10% PUA fee. Now, a question I like to ask here is, when you look at the differences, if these represented exactly what was going to happen, but if you looked at the differences here, when you see the $100,000 difference long-term by age 80, my question would be, during the first 10 years, when you look at the cash value difference, so for example, year 4, you've got $400,000, over here you've got $388, it's about a $14,000 difference in year 4. Is having access to that additional $14K up front, does that provide you more value than another $100,000 26 years down the road? Meaning, what can you do with the money now in the short term? Because some people will value that more because a life insurance policy, what's the net growth rate, the internal rate of return going to be? Somewhere between 3 to 5% if it's designed properly and such. So a lot of times people will position money here, but they really position it there in order to have access to it for opportunities. So that will depend on your situation there. But going back to what I initially said, most often will select this, the lower or the higher PUA fee, if I'm going to have more money long term. What's the key word in this video? Awareness, 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 awareness. Here's what I want to be aware of. Guaranteed illustrations. What do we got here? Well, same thing we looked at before. About what? No dividends. Just a worst case scenario. Now what do we notice? On the left, we've got our 5% PUA fee. Do we ever have a situation where we see the 10% PUA fee overtaken? Let's look at it year by year. So you've got the annual cash value growth. The guaranteed rate, by the way, is a gross rate of 3%, and it's the exact same product. The difference now is if we're only using that guaranteed rate of 3% and have a 5% PUA fee, it's a 2% spread, whereas over here, 7% spread. Those charges are gross too, which can be confusing. We've got content that goes through that. Point is this: when you isolate just the upfront cash value and break-even point, difference here, guarantees you're between years 6 and 7. What about the 10% PUA fee? This is usually what you'll see between years 9 and 10. So that's a big difference there. Again, we're looking at things on a very conservative, from a very conservative standpoint, minimum guarantees only, but there we go. How about long term? Let's look at age 80. What do we have here? Let's just highlight the bottom. The non-guarantees by age 80, what was the difference? $100,000. What's the difference here? $732 and the 5% PUA fee compared to this, $693. So if we want to round off, let's call it $40,000 in favor of the 5% PUA fee. So it's noticeable when I compare the two side by side. So again, awareness is key. This way you can see the options up front and select the one you are most comfortable with. I will say, in working with individuals, we've seen people select both. It is really a matter of preference and how you want to use the policy. But being able to see that up front is a huge help. And if you're concerned about maximizing the cash value up front and the guarantees, then the lower PUA fee is going to do the trick. If you're unsure, I would look at both, compare them side by side, really let the numbers speak to you and help you make a decision in that manner. And if you're really struggling, you could split it, whether it's a 50-50 split or a 70-30. That's a very easy case to position to an underwriter when we perhaps apply for one policy. Maybe it's just a L95 with a 5% or 10% PUA fee, but then we submit two policies for the same amount we were originally going to take. Let's say it was $100,000 with one policy, but now we're taking two with $50K per year. And we're just letting the underwriter know they couldn't decide between the 5 and 10% PUA fee, or they like both of them based on the potential and guarantees. This is why we're doing it, and that won't be an issue. I mean, that's why Guardian has these different options available, because they, like most companies, want your business. So I hope you enjoyed this video. I do hope that it was helpful. Let us know if you have any questions at all. Please feel free to leave them in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.